PA since 1982, mostly in real estate income taxation preparation, also audits of developers, um, and pretty much investors in the real estate industry. Um, in the year 2002, I ran into this 1031 exchange expert. And back then, it really wasn't as well known as it is today. He got me involved in it. He was a great guy, great teacher. And ever since then, I've been pretty much specializing in this. So I bring to you not just the experience of being a um, 1031 exchange, or the code section 1031, is it's a gray area, what we call a gray area. Okay. And when you get into these gray areas, and with the Internal Revenue Code, you need somebody who's very experienced with these tax returns to make sure that all the requirements are being met. So what we're going to do today, we're just going to do part one, which is the 1031 basics, what I call the 6 rules of a 1031. And so whenever you hear Internal Revenue Code or the IRS, or that sort of thing, it's a law. Now it's tax law, and a law is a law, meaning you have to follow it. Okay, if you don't follow it, you try to do different things. There could be adverse consequences. So in 1031, these 6 rules is what I call a safe harbor. Whenever you hear the word safe harbor, it means it's safe. It means that if you follow these rules, the IRS can't do anything to you. Now, I'm going to encourage you to ask questions, but there's going to be a lot of people on this, so I'm going to fly through this. Save your questions for the end, because at the end, after that, people are going to have to go to their appointments. But if you're able to hang out, we can sit and talk afterwards. No problem. So whenever you see safe harbor, you follow these rules. There's no issues. Okay. But like I said, this is a gray area, this code section 1031, meaning you can interpret the safe harbor rules differently. And so because of that, you're going to have a lot of questions as we move along. After we review the 6 rules and we understand these differences, I may go through a couple of strategies. There's something called the reverse, but it's more of an advanced topic. Okay. When we come back in the future, we're going to talk about how you guys can specialize in code section 1031 exchanges. Okay. And I'm going to show you how to, structure these contracts. I'm going to identify what your role is in the 1031 process. It's a really great, it's a great niche, if you will, to be involved with. You're going to make a lot of money if you understand this stuff very well. And that's my job, is to teach you that. Part 3 of this course is going to teach you all cool strategies. Okay. I combine code section 1031 with the principal residence exclusion. And you've probably heard that it's the $250,000, $500,000 exclusion. There's lots of examples I can give you. One of the things that, politically, not that I want to get involved in politics, but because of the new administration, they actually are saving 1031. If the other administration had gotten in, then their plan was to eliminate this entirely. So we're very happy that they kept it, because it's going to help the whole real estate industry in keeping code section 1031 on the books. And it will for at least the next 4 years. All right, so why are you guys here? Well, let me tell you why you're here, okay? In a 1031 exchange, what you're doing is you're going to sell one property, and in a very short period of time, you're going to buy another, okay? And so those are the rules we're going to go through. But what does that mean for you? Well, typically what it means is very simply, you're going to make a lot of money, because instead of having just one commission, you're going to have an opportunity to double your commissions, maybe even triple and quadruple if you're lucky, because these things multiply. All right. So if you think about it, you're going to sell one property and then you have to help your client buy another one in a short period of time, which we're going to go through. And so that's just going to generate commissions for you. So even though I'm an expert in 1031, my job really is to teach you how to make money doing these. And that's what we're going to do today. All right. So let's go through this. Rule number one. What is a 1031 exchange? Well, what it is you're selling one property and you're buying another. And what you're going to do is you're going to take this gain. So there's typically a profit, especially in the last 20 years or so. There's been huge gains in investment real estate. And so when you have a gain, if you don't do a 1031, you just close the transaction and you get your check, you're going to pay tax. And the tax right now is 15%, the long-term cap gain. Then you add to it something called the net investment income tax, which is 3.8% Medicare. Then if you hit certain levels of income, believe it's 400,000 for single, 450 if you're married, your 15% rate goes to 20%. So when you get to 20%, you're going to get the 3.8 on top of that. You're going to get to like a 25% tax rate. That's just for the feds. So, for example, if you sell a property and you have $100,000 gain, you can pretty much bet on 25,000 going to the IRS. But since we're in Florida, we don't have an income tax here. So we get to keep the rest. But others who live in New York, New Jersey, and 42 or 43 other states that are taxable, that have a personal income tax, they're going to pay tax on top of that unless they do one of these. All right. So we're going to be able to defer, okay, because that's what it is. It's a deferral. Okay. We're going to be able to defer that tax forever if it, until you either die or use one of the strategies that we're going to go over later. Okay. So rather than pay tax on that gain, we're going to roll that gain forward from the old property over to the new one. And when you do that within the 6 rules, the safe harbor rules, you will have no tax. You will defer. Now, there's a difference between deferring tax and excluding tax. Okay. A tax deferral means that you're going to have to face the tax of that gain sometime in the future. But for now, we get to keep that tax, which is great. And that's called equity. So whenever you get to keep your tax money, think of it, that's really your money. You don't really owe it down the road until you sell that new property down the road. And when you do sell that new property down the road, you could do another 1031. You can keep deferring this. And if you do it properly, you'll never pay the tax on this. And that's how a lot of these folks in real estate get wealthy. By doing these 1031 exchanges, you get to save your equity, and this builds wealth in real estate. It's really cool. One of the misunderstood parts of a 1031 is can a foreigner that owns U.S. real estate, can they do a 1031? And the answer is yes, because it applies to all taxpayers, as opposed to, for example, when you sell your principal residence and you want to take the principal residence exclusion, which we're going to talk about later. You've probably heard about that. So what the principal residence exclusion is when you sell your house where you live, okay, you can completely exclude from taxation the tax on that gain. You could exclude up to 250,000 of that tax. I'm sorry, 250,000 of the gain if you're single, up to 500,000 if you're married of the gain. So the tax associated with those gains is a lot of money. But with this, okay, 1031, it only applies to all taxpayers, whereas the principal residence exclusion does not apply to folks from overseas investing in U.S. real estate, even if they use the property personally, because you have to be a U.S. resident or have your green card in order to take the principal residence exclusion. Okay, so they're prohibited from taking the principal residence, but they can do a 1031. All right. And that's the cool part of 1031. It applies to all taxpayers. Now, I wanted to put that out there because I do get a lot of questions on that. So why do people exchange? Now, by the way, there is text that is associated with this PowerPoint that Juliana or Yasmin they're going to share with you after the class. So right now, I just want you to pay attention to this PowerPoint, and if you have questions, like I said, jot them down. We'll go through them later. All right. Um, so why do they do this? Well, the main reason is because they can trade or exchange their real estate tax free. Yeah, it's deferred, but if you play your cards right, you'll never pay tax. In that regard, I do consider it tax free. Okay, so it applies to both the federal and the state income tax situation. Okay, so if you have a client that's from New York and they either want to sell their Florida real estate, okay, and that real estate is qualifies for a 1031. We're going to get into that in a minute. They don't have to pay the tax, both the federal and the state on that. Okay. But again, it's a tax deferral, not an exclusion. Other benefits, sometimes people will exchange out of, say, land, like farmland, which may be tapped out, it doesn't produce anymore, but maybe a developer wants it, so they'll sell it to a developer, and then they'll take that money and put it in income producing property. Could be anything, a duplex, a house that they rent, commercial. So one of the benefits of exchanging is you can take real estate that's not being productive and increase your cash flow, turn it into cash flowing real estate. Like I said, this is a wealth builder. This is how a lot of people become wealthy, is by doing these 1031 exchanges and never paying tax every time they trade their real estate. Um, there's when you get into selling real estate down the road and these things go up in value, okay, you can take that equity and leverage it. You can sell one and buy three. You're not limited when you do an exchange to just selling one and buying one. You could buy more than one, and that's called diversification. The other way around is called consolidation. Let's say you're an investor and you're getting up there in the years and you're tired of managing real estate, you're holding 5 properties. Well, you can sell these 5, okay, and maybe just buy 1 or 2. You could decrease your holdings so that you don't have so many management headaches, okay? So that's called consolidation. We many times people are holding real estate for many years, and so what happens to their basis or their cost over those years is they become fully depreciated. Depreciation is a systematic write-off of the cost basis of the property over the years that you own it. When you sell that property down the road and it goes up in value, not only do you pay the gain on the tax on the gain of the appreciation, the amount that it went up, but the IRS makes you recapture the depreciation that you took over the years, all of it, and you pay tax on that too. It's part of the total gain. A lot of people don't realize that you're paying tax on that, what they call depreciation recapture. It's one of the things everybody forgets, except the accountants, if they're good. So, so your gain could end up being quite big, okay? But the thing about depreciation that's great when you're a real estate investor is you get this non-cash write-off every year, and you can take that write-off up to 25,000 on your personal taxes against your earned income. So you actually reduce. A lot of people get involved in real estate investments just for that $25,000 deduction off their income, as well as the appreciation they get. So there's this strategy that I'm going to share with you later, that when you can, if you're an investor and you live up north or out west and you want to come to no tax freedom Florida, okay, which is a no income tax state and it's the best state ever to live in, okay, well, they could exchange their real estate investments wherever they are, but it's got to be one of the 50 states in the United States, and they can exchange it for Florida. And when they do that and later on move to Florida, they can escape their state income tax forever. Okay. So with regards to the state income tax, many times that the tax on that part, the income tax from that state, gets not just deferred, but it can be excluded down the road. It's a kind of a little thing, a little secret that not many people know about, but I'm going to share it with you down the road, down this course somewhere at the end of the today's session. Okay, so rule number one. Okay, so there's 6 rules. There's 6 safe harbor rules that you have to remember for Code Section 1031. The first one is the qualifier. Okay, held for investment. Both the property that you're selling and the property that you're buying in this exchange have to be held for investment. All right, it has to be held for investment. Keywords. All right. So what does that mean? Okay. Well, held for investment in simple terms is either property that's rental, okay, because really what it says in the code, in the code section 1031, it has to be held for investment or used to produce income. So rental property is always investment property, always qualifies for 1031 because it's income producing. Land is always investment property, okay, because it's typically held for appreciation, which is the basis for the definition of investment. But what happens when you get into real estate that's maybe not rental property, but it's not also land? That's what we're going to talk about. But when they come back, when they're what they're referring to the IRS that's held for investment is that both the one that you're selling and the one that you're buying have to be what's called like kind. So in the tax code, if you look up code section 1031, oops, that's what it says. It's titled like kind exchange. Like kind refers to the investment nature of the real estate. So if you sell property that's land, which is always investment property held for investment, right? You can buy a condo on the beach as long as you do what? Rent it out. Okay. So how long do you have to rent it out? I'm going to get to that in a minute. All right. But just hold that thought. Okay. Because even though land might not, a condo may not be the same as land as far as zoning is concerned, as far as the IRS is concerned, it's the same. It's like kind. So whenever we are considering doing a 1031, we want to make sure that what we're selling and what we're buying is like kind. Like kind meaning held for investment or used to produce income. What is real estate, by the way? Okay. Real estate is dirt and anything attached. Okay. That's all it is. It's things that do not move. And 1031 only applies to real estate, dirt and anything attached. So things like, um, livestock, jewelry, art, boats, trains. It used to be you could exchange those and not pay tax, but they did away with that with the Tax Cut and Jobs Act in 2018. It was an offset that the Democrats and Republicans, they were arguing with each other, and in order to save 1031, they kept the real estate part, but they dumped the personal property part. Personal property is things that move. Real estate stays right where it is, dirt and anything attached to it. So I wanted to go through that definition so you understand what we're exchanging here. We're exchanging real estate. We can't exchange like livestock or say furniture that goes with the real estate. Theoretically, it doesn't qualify as real estate. But there is a way to include furniture in the exchange if you just listen to what I tell you down in a few screens down. Okay. So rule one, held for investment. What you're selling, what you're buying have to be real estate that's held for investment. Can't be personal use property. All right. So let's do it a real quick example. Peggy and Jim, they're selling a house. They bought it in 1988. They've rented it out, keyword rent, to tenants over those years. What they want to do now is they want to sell that house and buy a vacation condo on the beach. All right. And so what they plan on doing with this condo the new one, is they're going to rent it out to others, but they may use it a little bit themselves. So my question is, does this qualify for a 1031? So when you're confronted with this type of situation, so your clients are selling clearly investment property, you know this is going to qualify for a 1031. The question is, what are they buying? Okay. And if they're buying another piece of real estate, in other words, what are they going to do with the money? Right. Well, that's fine, and it would qualify as long as they claim it as a rental property for the first at least 2 years. They can use it a little bit themselves, but there could be restrictions. So we'll talk about that in a minute. So in general, does this qualify? Yeah, that qualifies for an exchange. Okay. So even though they're using it a little bit themselves, as long as they claim it as a rental on their tax return, they're going to be gold. Okay. They're going to be able to exchange that and not pay tax. So the next paragraph of that part one, that rule number one. So the first part of the first part of 1031 says, as long as the real estate is held for investment or used to produce income, you don't have to pay the tax on the sale. Okay. So then what kind of property does not qualify, okay, for a 1031? So, and this is important because we get this question a lot. Remember, I said it has to be held for investment. So the two words held for imply some sort of holding period, okay, that you have to hold that real estate before you can sell it and qualify for the 1031. So what does not qualify is property held for resale. And they give an example, for example, flipping, okay, or fix and flip. So you buy a property and you slap some paint on it, maybe do a little landscaping, and then 3 months later after you bought it, you sell it. That's called a flip. That's not holding for investment. That's holding for a resale as far as the IRS is concerned. Okay. So how do you get around it? Well, don't just sell it so fast. Rent it for a little while after you fix it up. Okay. Or rent it as soon as you buy it if it's in rental shape. Okay. But you have to hold it for a little while. Okay. Before you can sell it and do another 1031. Developers cannot do an exchange. Developers are actually holding their real estate to sell in the normal course of their business. And that is called property held for resale. Property held for resale, another word for that is inventory. Okay, so you and I, that we're just selling and buying real estate, we're not holding inventory, we're holding investments. Clearly, we would qualify. But a developer like a Horton or a Lennar, they don't qualify for this because this is their normal course of business. Okay. Um, Now, let's talk about how long you have to hold property. Okay. In general, you have to hold it at least a year and a day. Why a year and a day to be qualified as held for investment? Because if you hold a capital asset, which includes real estate, stocks, bonds, all that stuff, if you hold it for a year and a day, you now qualify for a what's called a long-term gain. Okay. So the IRS taxes gains differently depending on if it's long-term or short-term. Short-term is a year or less. Long-term is a year and a day or more. Okay. So if you can hold your real estate for a year and a day, even if you don't qualify for a 1031, you can still get that more advantageous tax rate that applies to long-term gains. Long-term gains start at 15%. And then remember, I said it goes up to 20 and then another 3.8. But if you hold it short-term, a year or less, and you sell it and you have a gain, that gain is taxed as ordinary income. And if you are successful realtors, like I know you are, because Lifestyle is a tremendous firm, okay, you're going to sell a lot of real estate here. You're not going to be in a low income tax bracket. You're going to be up there. So if you have real estate as investments, as a hobby, as whatever you're doing, and you sell it less than a year, then a year or less, then you're going to be taxed at whatever your tax rate is, which could be 28, 33, maybe more. Okay. So you really have to look at that. You have to consider that when you're selling your real estate. But I want you to understand this part. Remember, I said that 1031 is a gray area, right? So the IRS appears to be more concerned about intent than about how long you hold the property, because in Code Section 1031, it doesn't really set a time frame. So all the information that I'm sharing with you comes from years of experience. It's not explicitly stated in the code how long you have to hold it. It just says you have to hold it for investment. So what we recommend in general is hold it a year and a day. All right. Now, um, the reason why I put this word intent here is because sometimes in gray areas, facts aren't as clear. So they try to figure out if you did sell it less than a year, if you held it less than a year, let's say you held it 8 months, and then you did a 1031. Well, that could raise a flag, right? So they're going to come and say, maybe look at that and say, why did you do a 1031? Oh, well, a hurricane wiped it out. Okay, so we had to sell it and sell the land and buy something new. It just so happened that the land value was really higher, okay, than what we initially bought it for, rather than pay the tax. But you only held it 8 months. Why? You had a hurricane that came through and flooded the place. Okay, well, that's a good reason. Okay, or maybe you went through a divorce and you had financial troubles and you had to liquidate the investment as part of a divorce arrangement. For those reasons, they're going to allow that exchange. All right. So keep that in mind. It's a gray area. It's not written in stone. And then, of course, there's this thing called the safe harbor vacation home. So many people buy investment condos, houses in Florida. They don't want to rent it. They just want to use it themselves. Okay. Would that qualify? No. Okay. So then they want to know, okay, well, if I have to rent it, how am I safe? Okay. That if I sell it, within a year or two or less than a year, I can still do a 1031. The IRS in the year 2008 came up with this revenue procedure. Now, whenever you see revenue procedure, that means safe harbor. If you follow the rules, they're not going to bother you. Okay. So, like in the structure of the Internal Revenue Code is like this. So you have the Internal Revenue Code, which is like, I don't know, 25,000 code sections. It's a huge book. They don't even print them anymore. They're so large. Okay, so that's law. Okay, the code. Then you have what's called the regulations. The regulations attempt to explain things in the code that aren't so clear. So that's the regulations. And then over the years, they even went further and they have what's called a revenue procedure. Okay, so because each year during the year questions come up, and so the IRS gets written these inquiries. How do you handle this situation or that situation? And if there's enough demand on that one area that they may have overlooked something, they come up with what's called revenue procedures, and this is what we mean. And then after revenue procedures, there's called private letter rulings. Private letter rulings are not safe harbors, but if you follow them to the T, the IRS would approve, even though it's not a safe harbor. So let's talk about the vacation home safe harbor. What it says is, now, sorry, one more. All right, so this is where I want to go, but there's how do you one of the things of this course that I wanted you to understand was that how do you know um, that the transaction when you're meeting with a potential listing, how do you know that maybe that what they're selling is eligible for a 1031? So there's one question for you first one. The first question you want to ask is, how did you use the property? Because you don't know what they're selling, right? They could be selling an investment property, a vacation property, or the house where they live. If it's the house where they live, we're not doing a 1031 because that wouldn't qualify. The principal residence exclusion would. But if it's not their principal residence, if it's something else, that potentially could be a 1031. And for you, that could mean potentially doubling your commissions, right? So how did you use the property? Rev Proc 218, 2008-16 says that, and this happened in March of 2008, okay, that if you want to do a 1031 exchange and you want to know for sure that that is going to qualify, here's your guidance with regards to dwelling units. All right, so not dwelling units are residential properties. Residential, and this came up yesterday in a question with a client. What's residential? It's 4 units or less. Okay, so like if you have a fourplex, that's residential in the eyes of the IRS. If you have more than 4 units, then you have what's called commercial property, even though people live there, as far as 1031 is concerned. And with regards to dwelling units, which are defined as 4 units or less in one piece of real estate, all right, and they allow themselves for use. They have a for personal. Okay, so they have kitchen quarters, bath quarters, and sleeping quarters. With regards to those types of properties, we're going to require you to hold those types for 2 full years, two 12-month periods. So a year and a day does not apply for safe harbor, okay, with regards to dwelling units. They want you to hold it for 2 years. And in each one of those years, they want you to rent it at least 14 days each year at fair market value, which is a piece of cake. Anybody can do that. I can rent it to my kid for 14 days if I needed to, right? But here's the death knell with these safe harbor rules. Your personal use is limited to 14 days or 10% of the time rented. Okay, so for example, let's say you rented the property for, I don't know, you know, 200 days, okay, or 245 days. Let's say you rented it for 245 days. Well, 10% of that is what, 24 days, right? But you used it for 3 weeks, more than 14 days. Would that qualify for a safe harbor? So the answer is yes, because 10% of the time rented gives them 24 personal use days in that real estate, and they can still do a 1031. So, but typically that's not really what happens. They're not going to rent it. They're going to hardly rent it. Okay. So does that mean they're limited to 2 weeks per year personal use? Yes. But what about the days they're down there and they're painting or fixing the toilet guts or landscaping? Do those types of days count towards personal use? And so the answer is no. Those are days that we call getting it ready for what's called its intended use. So you always have to play this game with the IRS where your intent is to hold it as investment. Because if you're just hanging out there getting a suntan, it's not going to qualify. You got 14 days to do the suntan thing, but after that, you're going to have to document that if you did more than that, like go to Target and get housewares and stuff for the unit, then those days receipts will back that up. If you keep a diary, those days count as not personal days. They count as getting it ready for its intended use. So keep that in mind. So I want to get to rule 2 because we're going to lose. I'm going to lose some folks in a few minutes here. Rule 2. So rules 2 and rules 3 have to do with timing in the exchange. From the date of closing, okay, you have 45 days to come up with a list of properties that you want to use as replacements in this exchange. On that 45-day identification list, you can put up to 3 properties on that list. Okay. If you put up to 3 or less, there's no limitations. You don't have to buy all 3. Okay. But you can only put up to 3. Now, if you want to put more than 3 on that list, something else comes up. It's called the 200% rule. And I will tell you in practice, not too many people get involved with more than 3. And I'll tell you why in a minute. But if you do insist on putting more than 3, you're going to have to follow this 200% rule, which I'm going to get to you in the next screen. When you do identify, let's say you go into 3 or less, those identifications have to be specific. It has to be enough information for an IRS agent to get to the front door of that property. Okay, so you can only put the 3 properties. So for example, if it's a house, no problem. You have an address, it gets you to the front door. If you have a condo, you got to put the street address and then you have to put the unit number. If it's land and it doesn't have a specific address, you have to have a legal description on that identification form. So it has to get you to the point of origin on land. Okay. So that's how you identify property. So then they're pretty specific with this. The 45 days are calendar days. And this is important, not business days. So that means that holidays and weekends count. All right. There's no extensions on that 45 days. Okay. So keep that in mind. They're pretty specific. That list comes to me. I'm what's called a QI, a qualified intermediary. I'm going to explain what I do in Rule 4. But I have to receive that list up to 3 properties or less, signed and dated by the client, by the taxpayer doing the exchange by day 45, by midnight day 45. If I don't get a list on day 46, the exchange is over, they get their money back, and they're paying tax. Okay. Now, let's say, for example, you give me a list on day 20. All right. Day 30 rolls around. It's got 3 properties on it. Everything's great. Day 30 rolls around. Okay. And property number 1 on your list is no longer available, or you don't like it, or it didn't qualify, didn't pass inspection, whatever the deal is, and the other 2 you don't like. Can you shred that list and create another one? So the answer is yes, because you're in the 45-day period. You can change that list as many times as you want within that first 45 days. But the last one that you prepare, sign, date, and give to the QI is the one we're going to go by. So anytime you want to make changes, don't just tell me to take one off the list and put another one on. You have to do a completely new list, even if it has properties 2 and 3 from the last list on it. You still have to, we still have to trash that other one and make a new one. All right. So keep that in mind. And I'll take you through this stuff as we're doing it. When I do exchanges, we really hold the client's hands because I don't expect them to, retain all this detail. Okay. So a good QI will stay on top of it. Okay. Um, let's go back to this 200% rule, right? So I said that you have 45 days, you can only list 3 or less. If you go more, you're going to get tripped on this 200% rule, which states that sorry, my mouse is very sensitive. If you want to put more than 3 properties on your 45-day list, then the total value of those 4 or more, let's call it, okay, cannot exceed 200% or 2 times the price of the one sold. Let me go over that again. If you want to put more than 3 properties on that 45-day list, which means 4 or more, okay, then you have to add the total values of those 4 or more properties, and whatever that total is, if you can't exceed 2 times the selling price of the one sold. And if you do, then you got to buy pretty much all the properties that's on your list, which may not be your intention. Okay. So, for example, Peggy, she's selling her land, all right, for 100,000. She identifies 3 properties, each selling for $1 million or 3 million total. Is that okay? Well, yeah, it is, because she's only got 3 or less. Doesn't matter. There are no limitations at 3 or less. But let's change that a little bit. Let's say Peggy wants to identify 4 condos, and each one of those condos is selling for 100,000. Is that okay? Well, the answer is no, because now I'm past 3 on my 45 days, and so I've got to take the selling price of those 4 units, 100,000 times 4 is 400,000. Is 400,000 more than 2 times 100? Yes, it is. So if her intent is only to buy one of those condos, she's going to have to get rid of one. All right, keep the 3 or less if she wants to not trip on that 200% rule. So that's how it works. It's kind of funky, Congress comes up with this stuff, and then we have to abide by it. But again, with our clients, most of them, 99.9, don't get involved with this 200% rule. I encourage them to keep it to 3 or less. People going above 3 are very experienced, and they make sure they don't go over 2 times the property sold in order to get them all on there and still have and not fall under that trap, if you will. Rule 3, from the date of closing, you also have 180 days. to complete, to close, to get in title to the replacement side. Okay. Whatever you buy in that 180-day period, I have to see it on that 45-day list. I being the QI, the qualified intermediary. There are no extensions to this 180-day time frame. And again, these are calendar days, not business days. So holidays and weekends count. Hold on one sec. I had to grab a drink. Okay. So the 180-day rule is the easier of the two. The 45 is the one you really got to pay attention to. And in most cases, you're gonna get this transaction done, this exchange within the 180-day time frame. The only time I really run into problems is with new construction. People may want to contract on new construction to keep it as their replacement property. They got something to sell. Problem is, new construction goes past 180 days many times, maybe a year and a half, depends, right? So what do? Well, then you can't sell your old one until you get within that 180-day time frame. And then you have to account for when the developer says they're going to deliver it in January, but now it's going to be, March. So you don't want to go over your 180 days. So you got to play it, you got to play it cool. Don't blow it on this 180 days. It's very easy, but you can get lost in it if you're buying things that may take longer than 180 days to complete. So it looks like this. So there's a lot of people ask me, is the 180 days on top of the 45? No, no. So what this is, it's a 180-day clock. And day one, which is the closing date, okay, you have 45 days to identify, to pick your properties. And then once you do that, you have up to 180 days, about 135 days more to get it done. That's all it is. Okay, so it's a 180-day clock. It's not a 45 plus 180. You have to remember that. I want to talk about the qualified intermediary, my role in this. Um, and this is really important. So by law, okay, by tax law, you cannot touch the money, you being the exchanger, in between the sale of the old property and the buy of the new one. I got to keep you away from that money, what's called arm's length. Okay, I got to keep you away from that money. That means that when they close on their old property, this exchange has to be set up before. You can't go to the closing table and say you want to do a 1031. There's paperwork involved. There's agreements that the exchanger has to sign. And we have to make sure that that money is safe when it's handled between the title agent and the QI, because it's not going to the client, it's going to come to us. So there's wire instructions involved, there's protocols, there's safety protocols going on behind the scenes, and that all has to be set up prior to closing. Okay, so remember that. So in between the sale of the old, the buy of the new, the exchanger can't touch the money. I've got to hold it for them. I'm what's called a qualified intermediary. And that's why Miguel and I wanted to bring you this. I thought this class was great for you guys because this is so important. Not many people even know about these rules. So I'm so glad you're here today. But that money's got to be held by a QI. So what is this QI? Who can serve as a qualified intermediary? Well, in all the IRS's infinite wisdom, they don't explain who is approved. They tell you who doesn't qualify. And if you don't fall under the doesn't qualify, then you qualify. Does that make sense? So that's the IRS. Anyway, so who can serve? Basically, the QI has to be independent. The QI as defined in the code says that I don't have an interest in either the success or failure of this transaction. I'm just going to be there as a middleman to make sure that the client doesn't have access to the money and that they follow the safe harbor rules. Okay, that's what we do. Okay, so it also says that I cannot have been an agent of the taxpayer within the last 2 years. Now, except as a QI, I can be a QI agent for them in the last 2 years, but for example, I can't be their accountant, I can't be their lawyer or their title company, I can't be their realtor, none of those folks, those roles qualify as a QI. It has to be completely independent from the transaction. Okay. So now here's what besides holding the money, because so don't forget that money's coming to me. But here's what nobody wants you to know. Um, we're not regulated. Okay. Nobody looks at what we do. What is regulation? Well, with realtors, you have to go to class, you got to get a license, your license has to be held under a broker's license for a while because you don't really know what you're doing once you get your license, right? So that's all called regulation. There's classes, there's fees involved. It costs a lot of money to get a license. I don't have to do anything to be a QI, and I'm going to hold your money. So you need to be careful. You need to know how to pick movies, all right? Because we're not regulated. We have to self-regulate. So the first thing I want you to do before you recommend a QI is make sure they're bonded and insured. And don't just take their word for it. Get a copy. So if you go to my website, 1031connection.com, we put copies of our bond and our liability. It's like professional liability insurance, so that when I give you advice, you know it's the right advice. Okay. And I've held these insurance. A bond is insurance. Okay. It's just a little bit more official. A bond is that if I take off with their money, they have a way to get that back. Okay. Um, and make sure the bond is enough to cover the exchange. Okay. And make sure that the bond is per occurrence, meaning per exchange. Like it doesn't, it's not $1 million bond, for example, for all the 50 exchanges going on with this QI. It's $1 million for each one per occurrence. Okay, that's important. So bonds aren't cheap for a QI to get. They can be costly. So a lot of QIs, because they're not regulated, they won't get one, or they'll get a very small one. Okay, so make sure that they're bonded and insured. Okay, and don't take their word, get a copy of it. When they hold the money, where does it go? Who holds it? Okay, so what we do is we put it in what we call 1031 trust accounts. Uh, we use Lake Michigan Credit Union. We use Capital One. We use Huntington. We use Avid Bank. We have a lot of great banks out there that we hold money with. But I get to pick the bank. The QI picks it, not you. All right. So, so you want to make sure that where it's going, you understand where it's going. Okay. What bank? What's the account number? Ask questions. Okay. You want to make sure that the money that from your client, your exchanger, goes into an account by itself, not commingled with others. Okay, that's important. So we have non-commingled accounts. It's good for a couple of reasons. Number one, the bookkeeping's a lot better because we always know exactly how much money is in every account if we keep separate accounts. And number two, each account gets its own FDIC insurance. Um, are they experienced? Are they knowledgeable at what they do? A lot of these folks do this as a sidekick. So make sure you deal with people that are experienced. And do they use reputable, secure banks? I touched on that. Um, I would, a lot of people say, well, if they're not licensed as a QI, what kind of license should I look for? Well, I have a CPA license. So that CPAs are guarded by ethics and morals in their business. Okay. So even though the CPA business doesn't apply to QI, at least it's more assurance that you're dealing with a reputable person, as well as the attorneys are good. Okay. And you can look us up. Gosh, you can look us up on the internet. You can see if there's any complaints right on the license. What is it called? Sunbiz. Um, so, they're just things that you need to do or look for ahead of time before you recommend your client or yourself to a QI. You want to make sure they're reputable. You want to make sure non-commingled accounts, bonded, insured, all that good stuff. Rule 5, we're almost done. Rule 5, this is kind of a quirky rule within this code section, okay? But it's, as a tax preparer, I can understand their point. The taxpayer who sells the old property has to be the same taxpayer to take title to the new one. So And this is important because you're going to ask many times, for example, if you know your client's doing a 1031, maybe they're on the identification. They sold something up north to down here. They're looking for property. They got a hold of you through your website because you have a property that you're listing that they're interested in. Okay, so now they want to know, they like it. You want to draw up your contract. Who do you make who's buying the property? Okay, so if they're doing a 1031, you kind of have to know how they sold the old one because that's how you want to put the contract. So, for example, if the husband and wife sold the old property is in their name alone, that's how you want to make the contract on the new one because that's how you have to take title. If they sold it in an LLC or a corporation, then most likely we're going to have to take title in that LLC or corporation or trust or whatever. They have some of these people, sophisticated people. So we have to find that out. And that's really my job. Okay. But if you're unsure, just put them down as the buyer and then say and or assigns. Okay. Because they may have to assign it to an entity that they own. Okay. In order to make it qualify for the same taxpayer requirement. So the taxpayer who sells the old has to be the same taxpayer to buy the new. So, for example, Jim, he's selling his duplex. Okay, he wants to exchange it for 25% of a partnership. And that partnership, which is an entity, it's a taxable entity, okay, owns that building. Okay, so who owns the building? The partnership. So when Jim sells his old property, which was titled in his name alone as an individual, can he exchange it for a 25% share of a partnership, even though the partnership owns the building? Well, the answer is no. And so why not? Because a partnership files its own tax return. Form 1065. So as an accountant, I put on my tax hat. Basically, a partnership files 1065. A Form 1065 is much different than a Form 1040. So in this example, you don't have the same taxpayer. So how do we get it done? Well, Jim is going to have to take his 25% share, not in the partnership, but as what's called a tenant in common on the deed. So I see his name on the deed. That would qualify. Many times this is problematic because banks don't want to see individuals or minority shares on the deed when other people owe the money on the loan. So anyway, these are some of the issues that people come to us for because we have to kind of clear this up and pick it apart, put it back together again so it qualifies. All right, last rule, and then we're gonna break off for today, and then we're gonna or ask questions, and then I'm gonna come back hopefully in a few weeks to do another part. Okay, if you like this, then you're gonna like the other part. So there's two things that you need to do to pay zero tax. There's two things to pay zero tax. That's your goal. You don't have to do both, okay, and still do the exchange if it makes sense. But if you want to pay zero tax, you got to do these two things. Number one, you got to reinvest all the cash from the sale of the old property, which I have to hold for you. Okay, so reinvest all of it. Okay, don't take any to your pocket. And two, buy equal or more in value than where you sold. Okay, now if you owned the old property free and clear, no debt, so you sold it, and after commissions and closing costs, that money, instead of going to you, came to us. Then in that case, if you take all that money and buy real estate and don't put it in your pocket, you would have to buy equal or more in value than where you sold. But if you had debt that you paid off in the sale of the old property, that's where this buy equal or up thing comes in. Okay, because you have to replace that debt amount if you want to pay zero tax. So let's go through an example so I can illustrate this better. It gets a little hairy, but I tried to make it easy. Let's say Peggy, she's selling her rental unit for 110,000. Okay. And so there's going to be some costs involved. 10,000. I don't want to forget you guys. So the net selling price is 100. So even though the Contract selling price is 110. The net selling price is 100 because it took 10,000 to sell this property. Okay, so keep that in mind. Now we're going to pay off a mortgage of 40,000. All right. Um, Now remember, it does qualify because it's rental. That was one of the first things I should have pointed out. Anyway, so the net is 100. We have to pay off the mortgage of 40, so 60,000 cash will come to us, the QI, in this exchange. Okay, 60,000. So in order to pay zero tax, I have to do what? Two things. One, reinvest all the cash, the 60,000, and two, I have to buy equal or up from the value of the one sold. Well, what's the value? The value is the selling price minus your selling costs. In other words, your net selling price. That's the value. That's the figure that you have to get to or more to pay zero tax. A lot of people think that it's 110, but you do get to deduct those commissions and fees in figuring out the equal or up amount. Okay, so let's take this a little further. So Peggy, she's got 60,000. She's got to buy 100,000 or more. But what if she doesn't buy 100? Let's say she buys the new one for 90. What is the effect on the exchange? Okay. Well, there's going to be a $10,000 difference. And so maybe she gets 30,000 mortgage to add to the 60 to get to 90. Okay. Um, but she's going to pay tax on that 10,000. Why? Even though she's using all the cash. Why? Because on the flip side, on the replacement side, when she buys for 90, she only has a $30,000 mortgage now. When she sold, she had a $40,000 mortgage. So in the replacement side, there's less risk. The lower the debt, the lower the risk, right? That's a benefit. As far as the IRS is concerned, that 10,000 benefit is what's called realized gain. She's going to have to pay tax on that. Okay. But what if she doesn't buy for 90? Let's say she buys for 150. Okay. So she's going to buy up, way up. Okay. Well, that's a good start. But what she wants to do is she wants to get $100,000 loan. Okay. So if I forward 60,000 to the title agent and the bank gives her 100, she's going to earn 160. We pay 150. That difference of 10,000 is going to go to her pocket. Okay. Even though she bought up, she didn't use all the cash. Okay. She overextended. She didn't have to get a loan for 100. All she needed was 90. Okay. So the problem is, though, that Peggy needed that 10,000 because she wanted to pay some credit cards off and some personal debt. And, why not? Everybody should have that, ability to do that. Well, if you're going to do that, the IRS is going to tax you on that. So how do we get Peggy 10,000 without paying tax? Okay. Well, what we do is rather than get a $100,000 loan, okay, we get a $90,000 loan. Okay, I forward the 60 to the title agent. We close. No cash, equal or up. Everything's good. The next day, she can go to the bank and get a credit line on that property or refi that loan from 90 to 100, and she can pull it out that way because when you take out debt, it's not taxed. That's not a sale. Okay. So you got to play this little timing game here. And a lot of people say, well, you know, if I go and refinance the next day, that's just going to cost me a lot of refinance costs. Yes, that's true, except that this is just an example. And typically they'll maybe get a loan for, whatever, 500,000. And the next day they're out there getting a loan for 700, when some of these big properties. So they put money in their pocket without paying tax. Now, when you do that strategy, don't refinance the old one before you sell it. That would be boot. Refinance the new one after I'm out of it. That way, it's not taxable in that regard. So those are the 6 rules of the exchange. I'm going to come back and do more. Let's review them real quick. Both what you're selling, what you're buying have to be held for investment or used to produce income. All right, so it can't be personal use property. You have 45 calendar days to come up with a list of replacements in this exchange. All right, that list comes to me, the qualified intermediary. Okay. You have these are calendar days, not business. So holidays and weekends count. And you have 180 days to get this done, to get entitled to buy that new property. Both the 45 days and the 180 days run congruently at the same time. All right. They both start from the date of closing. All right. Um, one um, one item I wanted to point out here is a lot of people ask me, can they contract on the new property, even though they haven't closed on the old one? And so the answer is yes, because the IRS doesn't look at contract dates. All right, they look at the closing dates. Those are the dates, the closing dates that start and stop the clocks, not contract dates. So that's some of those things we discussed in the second part of this course. But I did want to point that out here. I thought it was important. Have to use a qualified intermediary, make sure they're bonded, insured, non-commingled accounts, and make sure they know what they're doing. Okay. And don't take their word that they're bonded and insured. Get a copy of it. If it's not on their website, have them scan it over to you because that's important. If they take off with the money, you got to have that to get it back. Okay. Um, Rule 5, whoever the taxpayer is on the old has to be the same taxpayer on title to the new, same taxpayer requirement. And 6, if you want to pay zero tax, reinvest all the cash, buy equal or more in value, and you're good. And you're good. So that's today's class. I hope you liked it. I want to come back and do more. If you guys are okay with that, we'll set it up at a time convenient. I know holidays are coming up, so we'll try to do it before we get to that point. Thank you very much. Are there any questions? Okay, I don't like see any. I know there's a lot of people here. Well, hmm. Okay, not yet. I think you guys pretty much picked up on it. I'm gonna get with Miguel, Yasmin, and Juliana, and hopefully set up another one. If you like this class, tell me you did. Um, my my email is well, Yasmin has it. Okay, it's at the end of this course of this PowerPoint, which they're gonna share with you, and then we'll do it again. Okay, and if you do have questions and I can't answer it here, just email me. I have pretty much half a day every day that I'm just hanging out. Um, so I would love if you ask me questions or if you even call. All right. Thanks again. I hope everybody enjoyed that. I'm going to stop sharing at this point. Um, Hang on. Let's see. Great, great, great. Oh, thank you, thank you, thank you. Okay. Juliana's. I think she put a PDF here for you guys to look at, and that's it. Thanks very much. Thank you for the positive comments. I appreciate that. Um, let's end this here, and I'll see you guys within a few weeks, I'm sure. Have a great day. Good luck.